if you held on for 1 year, your average returns are 16%, yes, but there is a 25% probability that you will make less than
loss.
Hello, everyone, and welcome to our show, The Mutual Fund Guys, where we only speak about mutual funds. Hi, I'm Samir, and across is Mahesh.
Hi.
Both Mahesh and I are partners at AMS Investments, which is a mutual fund distributor based out of Mumbai and in Dubai. Today's topic is going to be a very interesting one. It's going to be why should we invest for the long term? And when we speak about long-term investing, we are talking in particular about equity mutual funds. Why should you invest in equity mutual funds for the long term? And when we mean long term, I'm talking about 10 plus years. But we've heard time and again about investing in for the long term. You know, there are newspaper articles, there are videos on this, but not many of us do it. But today we're going to talk about, give you some numbers, give you some practical examples as to what long-term investing does for you. Okay, what are the benefits of long-term investing? And I think once we go through these numbers, these are very practical numbers. You don't need to be a mathematician to understand these numbers. It's quite simple, straightforward. Almost everyone will identify with it. And you will realize through this process today why investing in the long term makes a lot more sense than investing in the short term. So Mahesh, let's help our investors understand the benefits.
Clearly, what you said is very important. Everybody says buy and hold for the long term, but really very few people, I think, have gone ahead and showed why. I mean,
Yes.
explain from data why. And that is what our attempt is. So I'll just share this presentation you can see on your screen now. And
Yes.
what you see on the right-hand side is something called the 1-year rolling returns, right? So these returns, first of all, let me just clarify, are all compounded annual growth rates, which means that on an annual basis, these are the kind of returns that have been experienced by investors.
So 10-year, 14% would be every year you made.
Yes. So if I say a 10-year return is 14.18%, then it means that on an annual basis, you have earned that 14.18%.
Every year you've earned 14%
for 10
on
years,
average.
right? So that's a large number. Right. And these returns have all been shown from January 2000. So this is from January 2000.
24 years.
Yeah. So it's for 24 years. And when I say 1-year return, it's not 1-year return. It is actually 1-year rolling return, which let me try and explain what it means is that say you bought in January 2000 and sold in January 2001. That's 1 year. So that's a holding period of 1 year. So that is 1-year return. Similarly, you could have bought in June 2000 and sold in June 2001, or in October 2000 and October 2001, or in February 2002 and February 2003. So these kind of 1-year periods are all called 1-year returns, rolling returns, 1-year rolling returns. Right?
Average.
So when I looked at these returns, there are 217 1-year returns that you could have had from January 2000 till date.
Instances,
right? So you could have bought at any point in time and held for any point in time. We have 279 data points of such returns. And the average return that an investor would have experienced if he held just for 1 year is 16.5%.
On average, yes.
Yeah, that looks good. That looks good, right? Why not 16.5%? Absolutely fantastic. But there is a problem. The problem is that 25% of the time, any investor who held only for a year would have experienced negative returns. He would have made negative returns. You know what it means, right? So that is what the investor would have experienced. And even worse, most investors don't invest only to make positive returns, right? They want to beat FD returns.
Of course.
More than FD returns. Tells us that I want to invest in equities will say, finally, yaar, FD se to better banna chahiye, nahi to main equity mein kyun dal raha hu types, right? So that's the experience we've had with most investors. So what we see is that if the holding period is only 1 year, on an average, 31% of the time, you will make less than FD returns. In this 279 instances we have from January 2000 to now, 31% of the time, you wouldn't have even beaten FD returns if you held it only for a year.
Correct.
Right? So that's the kind of thing we see in terms of the data that we have for this period of time. Now, If we just increase the holding period from 1 year to 3 years, which means now we are looking at 3-year rolling returns. You could have bought on January 2000 and sold in January 2003, or June 2000 and sold in June 2003, or October 2002 and sold in October 2005, and so on and so forth. You know how I'm going with this, right? Any point in time you buy and hold for 3 years. So your holding or investment period is 3 years. Then the kind of return you would have made on an average is 15.8% annualized. So every year you would have made 15.8.
15%.
So that's
on
the
average.
average
On
return
average.
you would have made. Yes. But the better thing is that in the 1 year period, I said that 25% of the time you would have seen negative returns. If you hold for 3 years, that negative return period would have dropped to, the negative return number would have dropped to 4.3%. So instead of 25% of the time, only 4.3% of the time you would have experienced negative returns if you held for 3 years. And the amount of times you would have made less than FD returns is only 13.3.
Oh, phenomenal.
So it means that if you just increase your holding period from 1 year to 3 years,
3 years,
you will make better than FD at least 84% of the time.
Which is very good.
Right.
Yeah.
So this is what data is telling us. This probability is, this percentages that I'm talking about is hard data for the last 24 years. This is the hard data. Now, if you expand it to 5 years, the things are even better, right? So you will make 15.4% on an average. You will make negative returns 0% of the time, and less than FD returns only 5.6% of the time, which means that there's a 94% chance that you will beat FD if your holding period increases to 5 years.
It's amazing.
Right?
And it's pretty
And now, if we just increase it again to 10 years, then your average return drops a little to 14.18%, but there is a 0% chance that you will lose money ever. And there's a 0% chance of making less than FD returns. This is data. So if you bought at any point in time and held for 10 years, then you would not have made less than FD returns in that period of time.
It's a simple logic here. The longer the time, the greater are the chances of beating fixed deposit returns and achieving positive returns overall. In a 10-year basis, there is no question that you would have always beaten FD returns, and you are amazingly high.
And we want to be very clear here. This is the past, right? This is what has happened in the past 24 years. There is no guarantee that these things will repeat in the future, but we can only know the past. So we look at what has happened in the past and try and extrapolate how things can work out in the future. It clearly shows, the past data clearly shows a trend where the increasing of the holding period or the investment period improves your chances of getting better than FD returns, improves your chances of not making a loss, and improves your chances of getting a very decent return on your investment.
I want to make one very big point here, and this feeds directly into what you're saying. There was an article a year ago that mutual funds do not hold on to their equity mutual fund portfolios for more than 1 year, and this is one of the classic reasons why. So in your chart that I see, if you held on for 1 year, your average returns are 16%, yes, but there is a 25% probability that you will make less than
loss.
You'll make a loss. You'll make a negative return. Which means that there are a lot of investors who look at this. They remain invested for 1 year in a mutual fund based on some advice they got from somebody, expecting that they will make those 16% returns or 20% returns, whatever it is, right? But that does not work in short time frame, as you mentioned. And then they exit out after a year, and obviously they lose all the faith in mutual funds because they were in such a short period of time. But had they just remained invested for 5 years, for additional, they would have seen the benefits of mutual fund investing. And of course, 10 years is a different story. Even if they went from 1 year to 3 years, held on to the investment for additional 2 years, they would have seen a marked improvement in their ability to have made positive returns in that period, right? This is what people are missing out on, Mahesh. They get into an investment vehicle like mutual fund, expecting past returns to follow immediately in the coming year, okay? And then they forget that the past returns are an average of the last 10 years. Is not something that happened immediately, right? So people make this mistake and they get disappointed, they sell their mutual funds and they move out, and then they lose out on the benefits of long-term investing, which is what we're trying to tell you. Look, if you want to be in mutual fund investing, if you want to be a mutual fund investor, then be prepared to be invested for a long period of time.
The other important point to note now, Samir, is that it is very nice to say that if you held for 10 years, you would have made no loss. I mean, you would have made loss 0% of the time, or you would have not made you would have made more than FD returns 100% of the time. It's very easy to say that. But the investor who goes and holds for 10 years also obviously experiences the 1-year rolling return, right? So 25% of the time in that 10-year period, there is a chance that he would be making a loss in any given year.
Correct.
Right?
Correct.
And there would be a 31% chance that he would be making less than FD in that 10-year period. This is the real experience that an investor has to go through to reach that 10-year investment period. So almost all investors, I do believe, actually start off by thinking कि मैं तो long-term investor हूँ. But when that first year the market hits you with a negative return, that's when they stop being long-term and then they say कि I don't want to be invested. This is all crap and I don't think I should be investing at all. I should go back to my FDs. The point is that we want to tell people that investing is for the long term, yes. And also you better believe that in that long term of 10 years, there will be periods of time where it will test your ability to hold. The market will test your ability. Nothing comes for free. You will be tested. You will be tried. The market will test your patience before it gives you the kind of returns that you expect the market to give over a long term. So this is what data is telling us. So you can't really expect that you will buy and hold for 10 years and not be tested by the market at all. It will test you. It will make you break your resolve. But yet, anybody who holds through all that and waits for 10 years, the past data has shown that they do get rewarded very strongly for that patience and for that effort that they take.
It's a very important point. It's harder to practice than it is. It is quite hard to practice to not be swayed by short-term returns. Like I know for a fact that I was invested in a mutual fund for 2 years and I actually had just, I think 3 or 4% return, right? And that same fund is I've still invested in the same fund, but that has now eked out a pretty decent profit because I just stuck around for those many years. And it's a hard thing to do. It's not easy. You approach mutual fund investing with that long-term view, but stick to that long-term view then. Don't change your mind after 2 years. The patience game is the important game. And the numbers prove it to you that if you're patient with your investments, then long-term will, at least in the past, has shown to make you good money. So that is these are great numbers, Mahesh. This is exactly what people should see. It's practical. It makes more practical sense than listening to somebody saying long-term is best, long-term is best, long-term is best. But why is it good, right? Give us some numbers to prove your thesis, right? And this proves the thesis. And these are factual numbers. These are not made up. These are actual factual numbers. So thank you, Mahesh, for presenting this. And thank you everyone for watching. We will be coming up with more videos on why long-term investing is essential, why long-term investing is quite hard, and how can we sort of remove some of the biases that we have in long-term investing in our subsequent videos. So stay tuned and we'll be back shortly with more and more interesting content. Thank you.